Welcome to News You Can Use, presented by Supreme Lending. News You Can Use offers timely information related to the housing and housing finance industry that we believe will benefit you and your customers. This is News You Can Use.
I want to remind everyone today that we all have the opportunity and, in my view, the individual responsibility to be a part of keeping this nation not divided but united. The way we can do that is to adopt a simple philosophy about how you experience others, and that is, I am for everyone. I'm not for everything, but I'm still for everyone. Remind yourself of that when you're hearing all of the talk that's going on today, so that we don't allow ourselves to be divided, because families divided, businesses divided, a nation divided, they cannot stand. That's what the scripture says. Let's go back to the beginning of the year. Don't we wish we could go back to the beginning of the year? Happy New Year! It's 2020, a new decade began. My goodness gracious, prior a year and 2 years, we had almost 7 million jobs added, such that our unemployment went down to an all-time record low in our country. We began the year, January 1, 2020, with a 3.5% unemployment. We had never been anywhere close to that. Stock prices were at record highs. Median household income was up 2.5% from the previous year. Median home prices, a good news story for all of you and myself. You know, my goodness gracious, they were increasing on the regular for the previous 3 and 4 years. We had an aggregate of about almost 20% increases. And GDP was running about 2%. Not the best ever, but pretty darn good. So we began the year, there was an awful lot to celebrate on January 1st. And then, right, our lives changed. Every single one of us, not only in America, but around the world. We all were hit by what is now known as coronavirus, COVID-19, a pandemic. The first one in a number of years took place, and it took place worldwide. It caught all of us off guard, and it essentially changed everything about 2020. Our first focus, all of our focuses from the government all the way down to local government, businesses, was to flatten the curve. Since we had never dealt with COVID in the past, we really didn't know how to treat it. There was, of course, no vaccine because we had never dealt with it in the past. And so we decided that if we sheltered in place, if we essentially kept distance from each other, if we wore masks, if we ever did go out, that we could flatten the curve. And what would that do? That would effectively just slow down the spread of the virus. It wouldn't get rid of the virus, it would slow it down so that our hospitals and our medical field could go to work to begin to learn about COVID, how to treat it, and then ultimately how to get a vaccine so that we can not only treat it, but conquer it. Well, when we flattened the curve, told everybody shelter in place, told everyone to stay home, we shut the business of America down. That was, at the time, the best alternative we had to deal with COVID-19. It's essentially, because we're in the health conversation, a self-induced coma that we put our economy in. We intentionally did it. We had never done that before. And again, we started the year with one of the best economies ever in our country. And now all of a sudden, we're going to do something unprecedented, which is to shut the economy off for all intents and purposes. Almost all businesses were temporarily closed. An amazing challenge that we were going to need to deal with. Let's see what happened next. We decided, okay, we had flattened the curve, and we got into May. We started this in March, the coma. We got into May, and we were feeling the pressure of reopening. By the way, it's not natural to stay home that long, and it certainly was for businesses and individuals, let's say, a bit impactful from an economic standpoint. Beyond the health issue, there was the second issue, the economy, right? And it was growing massive concerns. So we decided in May to push the restart button. There was a lot of different opinions, people for, people against. Again, we're not always going to be for the same thing, but we can be for people. So we restarted. What would the recovery look like? That's where we went to next. Well, we had never shut or put ourselves in a coma before, so we didn't know. So basically the economists that were out there started to do a lot of study on this. And they gave us a number of different recovery ideas that we could expect. The first one was the V, the victory. This is the one we want. We went down, we shut it all down, we turn it back on, we go right back to business as usual where we were at the beginning of the year to celebrate. Linger at the bottom. Not the worst, that is the U, not the worst idea, not as good as the V, but not the worst idea. The W, well, we introduced this a couple weeks ago because we went down, it looks like a V, and then because of Corona or COVID-19, a revisit of it, we may have to shut it down again. There's a number of people still asking and calling for us based on new cases, we'll get to it in a minute, that it could turn into a W if we have to shut back down again. Then there was the Nike Brilliant. How they got in, I don't know, but the swoosh. We go down and then we just gradually recover. And finally, this was for a long period of time, the L. The economy goes down and it never recovers. That's not what we wanted. Most recently, last week, a new idea was offered by a number of leading economists, and as the radical sign, I don't even know how to explain this to you completely, but this whole picture just reminds us of the unprecedented, uncharted territory that we found ourselves in when we self-induced a coma as a result of COVID-19. Let's talk about what we're tracking to see how the economy is recovering, right? Not which recovery, but how is it actually happening? The first thing is we're tracking actually directions in Apple Maps. Why? Because, well, people weren't moving around a lot. You could see that. It went straight down. Nobody was looking for directions for walking or driving. Certainly transit got closed and is still closed. We did see an increase as May started picking up in driving direction requests and in walking direction requests. On the walking front, a lot of dogs were hoping that we would go back to work as well because let's just say they've gotten a bit too much exercise this year. Amen? Yep. All right, here we go. So, restaurant bookings. Most of the job loss in our country were in the service businesses. Certainly the restaurants were hit very hard, very quickly. You can see we went from like the peak when March, actually the shutdown, to down 100%. All restaurants were basically closed. Oh my goodness gracious. I know it's a long time ago now, only 3 months, right? But amazing. Now we're on our way back. We're still down 65%, but we're making some progress. Grudgingly, we're making progress. And as the news about cases is on the one side, it limits progress. That's just a reality. COVID itself is creating the tension. We'll get to that in a minute. Hotel occupancy rates. These have been proved. One thing, though, not to miss, Doug Duncan, who was on our show last week, the chief economist with Fannie Mae, reminded us that hotels really make their living on conventions. So even if we get back to 100%, we got to see people on planes again, traveling, congregating at hotels, doing conventions where they spend an awful lot of money on meals, entertainment, you know what I mean? So hotels, we're tracking that, getting a little bit better. Air travel is kind of flattened out. It made a bit of a move from the bottom, but we're talking about 70% off from where our normal life was when we started the year of 2020. So these are the things that we're watching closely. And guess what? We're also watching. We're watching housing be a V. Victory! We are so blessed, all of us, to be in an industry that one would have believed with the job loss, one would have believed with the confidence issues, one would have believed with all the news that our business would essentially be way down. And it went way down. Look at the numbers from where we were in March. April does a huge dive down almost 35%. But then we start looking like a V because we run right back up. And now we're at a pace in housing, frankly, at this point, we haven't been at a very long period of time. So, if you're one of those folks out there like we are as an organization that's been blessed by what's happened in our recovery, make sure you love your neighbor. Be more generous this year. All right, let's go to this whole idea of the economy on one side and coronavirus on the other. The economy wants the recovery. We want to go back to restaurants. We want to get on planes again. We want to travel again. We want to go to games again. We want to do all those things and spend money doing them, and that would benefit the economy. But we've got this weight, and it's a weight of fear about what is coronavirus going to do to me? Will it put me in the hospital if I come in contact with it? Will it actually cause a death? I mean, these are the things that are actually going on for Americans. And fear, I would tell you right now, according to Doug last week, is the number one thing that is going to keep the economy from recovering. Let's get some data to you now, because what you hear every single day, the media, is that we are at records in terms of new cases of COVID. By the way, this is a virus. It's not going away. I don't care if we shelter in place, wear a mask. It's not going away until we get to vaccines, until we get to better treatments. It's not going away. It's going to be a part of our life. So we have to manage it well. Well, cases are all the way up, but let's start with new tests. A lot of noise about tests and new cases. There is, in fact, truth that we are testing a lot more people today, 800,000 a day plus, versus where we were just 2 months ago at 200,000 a day. That's true, but what is also true is that new cases are, in fact, growing faster than the tests are. So it's not just that we're testing more people, that we're getting more COVID positives. In fact, we're seeing that there's about a 5.5% increase the number of people when they get a test from May 1 to today that are actually testing positive. So we've gone from about 8% up closer to 13%. That is COVID positive test based on tests actually performed. So that's not a great number, but it is what's happening right now. It's true. And again, we're all going to come in contact with this, so we'll get to that in a minute as to how it impacts all of us. Current hospitalizations, there's no debate. They are up. When we shut down, we saw the hospitalization rates go down, right? Because we're sheltering in place, the economy was closed. When we open back up, it takes a little time for people to come in contact with it, then they get sick, and some have to go to the hospital. So these are delayed numbers based on our reopening of the economy. Fact of the matter is, while cases are substantially higher, 400% higher, okay, that's what's happening. We also are seeing that the death rates are not growing at nearly that rate. They're up some from the last month or so. In fact, maybe up about 100% from the last month, but that is substantially below, let me say that again, substantially below the rate of COVID-19 confirmed increases. So we're getting cases rising at about 400% over the last month or two. Not good, but again, it's a virus. It doesn't go away. We're out and about. It's the summertime, and people went back to work, et cetera, et cetera, et cetera. Then what we're seeing is actually deaths, and that's the fear that all of us have, of course, right? It's not getting it. It's the impact of either getting hospital, getting so sick that you have hospital, or God forbid that you'd actually pass from it. So what we're seeing is we were down about 500 deaths per day in America going back about a month, okay? A little less than a month. We're now up to just under 1,000 a day. So we'll continue to watch this number. As long as this number flattens out about at this rate, the economy will stay open. Therefore, the W probably goes out, and then we're either playing with probably not a V, but a U, or some recovery that continues. This week's a big week. We'll get more news about that here for you in a second. One thing that we are very optimistic about, when we look at the data, really get to the data, we look at the death counts by age in our country. And then we look at the new confirms, COVID confirmed cases, and we look at the rate of death retrospectively. We look backwards, and when we see that, we feel like death rates will probably flatten out. They may go up some like they already have, but not nearly as fast as the cases are going up, because we have now so much more knowledge about who is most likely to get sick and die. And we have so much more knowledge about how to treat COVID-19 than we just did 3 months ago when it first showed up. We just didn't know. Back to deaths for a second. Certainly the newest states where this COVID-19 is running rampant right now in terms of new cases, Florida, Texas, California, Arizona. Well, in the last couple of days, the reason nationally why death rates have gone up some, and again, only about a little less than 100% versus the 400% in new case confirms, new cases. So it's a lot better than the cases. But we are starting to see some of the rates kick up, particularly in the states where the cases are growing fastest. And now what we found out is California, not New York, California now leads the nation. This is not one of those things you want to be first in, by the way, as a state. It was Florida, but California now leads it with 440,000 COVID-19 confirms total. Logical, California is the biggest state in the country, most populous state in the country, that California would ultimately have gotten to a position that you didn't want to be in, which is the lead. But it's likely, again, it's a virus. It is going to spread. Let's take a look, though, at another really interesting piece of statistics, because I think this is helpful and it creates some hope for us. This is the death toll in New York City, or in New York. 32,000 people died there. That is 1,679 deaths per million people in New York. So again, there's 33,000 deaths in New York. There's 1,679 per million that have actually died. New Jersey, there's 15,800 deaths, 1,785 deaths per million. So those were two of the early. So was Connecticut, 4,400 deaths so far, smaller than, of course, New Jersey, which is smaller than, of course, New York. 1,237 deaths. So those numbers, deaths per million, are pretty important. Why? Because this was early where COVID was back in March and April, and we learned a lot about how to treat it and who gets impacted most. Now let's shift. Texas. They have 5,000 deaths so far. They only have 174 deaths per million people. That's 10 times less than New York, New Jersey, and Connecticut. Let's take a look at Arizona. They have 454 deaths per million, not as good as Texas, but way lower than what we saw, 400% lower than what we saw up in the Northeast. California, very similar to Texas, very low death rate. There's 8,400 people that have died, and no deaths okay, so we're just giving you the news. Florida, 5,800 people have died, as opposed to New York with 33,000. They're about the same size state, by the way, same amount of people. 272 deaths per million versus New York, 1,700. So Florida's basically 10 times, and Georgia, the state that I live in, 329 deaths per person. And again, that is about 8 times lower than the death rate of New York. And we're talking about this. Listen, these are COVID confirms and the people that actually are dying. So when we look at the number of people in the state, we look at the deaths per million, the numbers are going really, really low. And that's really two things. It's older people, three things. Older people now realize that if they have any underlying illnesses, they need to stay out of the crowd. We're treating it much better. And because older people are not out in the crowd, you know who is? Young people. That's right. We sometimes are not for them because of what they're doing, right? Not social distancing, having a great time, acting like young people. That's what they're doing. Here's the good news, okay? The good news is younger people are a lot less likely to be hospitalized and a lot less likely to die. Here's a great way to look at it. These are the states early on, New York, New Jersey, Connecticut, Massachusetts, all up in the Northeast where COVID showed up early in March, probably earlier, in February. Okay, look at the death rates. COVID confirms to those who actually died. Now look at the right of the graph. Texas, Arizona, California, Florida, Georgia. They didn't get it for about 60 days, and now it's really ramping up in those states. But the treatments are so much better, and there's more younger people getting it because older folks have figured out they need to kind of shelter in place still. And then our treatments are just much better, and younger people, again, are certainly faring much better with this thing called COVID-19. The cavalry is coming. Our medical fields are really working right now. We're getting a lot of really positive news, not just from the president, okay? That's important. From the medical field, A lot of people are confirming that we're getting closer and closer and closer on vaccines. We could get a record here in terms of getting vaccines available to the population of America, which would materially bring down fear, which is good for the economy, would materially allow us to not only stay open, but to feel more comfortable about going back to a way of life that all of us are desperate sometime to get back to, okay? So that's what's up right now is we're working diligently. The medical field is. They're all locked in, not only on vaccines, but on treatments that could take those that do get sick and go to the hospital, which they've made a lot of progress already with that, and really continue to improve, and therefore death rates for those that do get COVID, that do get sick, that do go to the hospital, will continue to decline. That's what our hope and prayer is. It's what we're trying to get to, right? All right, what should you do? First, you've known this from the beginning, but don't forget, wash your hands often. Wash them often and wash them good. Get in between all those little webs there, okay? Take a long time to wash them. Make sure you get them good. Keep social distance. It's just smart to do it so that you don't wind up coming in contact, because as long as we can delay this virus, which we'll all probably cross paths with at some point, coming in contact with us, the more likely we'll have gotten a vaccine for it, and the treatments will be much better, and then the outcomes for all of us will be much better. And finally, please, 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 don't feel like you've lost a right when you wear a mask. Feel like you're giving your neighbor the right to feel better. Love your neighbor, even if you don't. If you're not for mask, still be for other people who are for mask. So just wear the mask. Love your neighbor, wear the mask. I don't like wearing masks, but I wear them. Why? Because I love my neighbor and I want them to have less fear, because if they have less fear, they're more likely to come out. And if they come out, driving directions, walking directions, they'll go to a restaurant at some point again. They'll actually get on a plane at some point. Come on, we all just need to get the mask on and do our jobs, right? So that we can conquer COVID-19. All right, let's shift. Next week, this coming week, is one of the newsiest and most critical weeks for the summer markets. Why is that? Well, first of all, the Federal Reserve is meeting again this week. We've said from the very beginning the Fed has done anything and everything, and then even more than that with regard to monetary policy in this country. They dropped interest rates. They bought a bunch of debt. They've sponsored every single area of the economy to keep our coma patient healthy. When it came out of the coma, they've done everything they can to give the right opportunity for the patient, called the U.S. economy, to fully recover. This week also, negotiations are underway on the next round of stimulus, right? So we've already done stimulus of just under $3 trillion now. That is, we did stimulus. We gave unemployment $600 additionally a week. We gave individual stimulus checks out. And beyond that, we've done the PPP program, right, which is the payroll protection plan, so that employers did not have to let go people. They could actually get money from the government to keep their jobs on. So we've done a lot this week. It's a big deal. But the other thing's going to happen this week is really going to be difficult and sobering. And that is the GDP, the gross domestic product, all goods and services. How did the economy perform in the second quarter while it was in a coma? Not good, okay? We think the number could be as low as we lost 35% in one quarter in the economy. That will be by far a record, more than in the Great Depression. So that's what happened when we put this economy in a coma. We actually shut it all down. Growth went all the way down. As of course you're seeing now, we're going to do better going forward because the economy is getting better. Certainly not where it was when we started the year, but it is getting better. Let's talk again about our business, can we? Please, because we've got something good to say. We should say it because the news you can use is good in our industry, so let's use it. All right, mortgage rates just hit another record low, and they could go even further down, according to Doug Duncan. We've got more room to go, so don't tell everybody that. They may not buy a house today. They might wait. We don't want them waiting because they already have the best record rate in history right now. In fact, Doug Duncan is saying that almost 60% of the mortgages in the market based on where rates are could still refinance. That's a good news story because every time people refinance and save money monthly, it's a stimulus, a different kind of stimulus, but it's a stimulus nevertheless. Long term, they get to take more money in and keep more of their money because their mortgage payments are lower, in which case they can put it back in the economy if and when we all wear our mask and we can all go out again because we're not afraid to go out. All right, let's take a closer look at what Doug Duncan's forecast, Fannie Mae's forecast. And I'll just remind you, Fannie Mae is the biggest housing company, finance company on the planet. That's right, which makes them the biggest housing finance company in the universe. They issue more housing debt than any other company other than the U.S. federal government's debt, our treasury debt as a nation. The housing industry's debt is the second biggest, and Fannie Mae is the biggest issuer. These guys are pretty darn good about forecasting what's up in our business. Last year, 2019, there were 6 million units sold in housing. Because of the second quarter going down so far, so fast, stayed down 45, 60 days, we lost let's say about 15% of the year during that quarter. We're going to be down this year about 6.9%. Of course, we're back up right now and the market's really good, but we're having to make up for that big ditch that we went into when we put the economy in a coma. Next year, the good news is it's going to be up next year about 5%, actually closer to 4%. But the good news story is from this time to the end of next year, each quarter we're going to see increases in housing. So it's going to get better from here, believe it or not. We're going to see housing actually getting better and better and better. So good news story. Interest rates, I already brought this to your attention. Last year, they were 3.9 fixed rate. This year, they're going to average 3.2. And actually, they've gotten a little bit lower than that right now. 2021, the projection is we'll be actually at below 3 into the 2s, which is another good story if you're in the housing business. And I want to show you one other thing because it's really important that this is news you can use, that you need to understand about what's going on in the marketplace today. Let's go all the way to the bottom. Mortgage originations include purchase money mortgages, what we do with you as our partner every day. And they also include refinancing, which again, we said is a good stimulus for the economy right now. But let's look at 2019. 2019, the purchase mortgage market did like $1.3 trillion worth of mortgages. The refinance market did $1 trillion in mortgages, okay? This year, the purchase market is not going to go down to 6% like sales are. That's because values of housing is going up. So that kind of offsets some of what's happening with the sale numbers being down. But this year, about the same as last year, $1.25 trillion in purchase money mortgages. This year, 80% increase in refinances, almost 90% in fact, 1.8 trillion. So there is a amazing avalanche of refinances, which is distracting every lender out there in the marketplace. Next year, by the way, we'll see that 1.8 trillion go down to $1 trillion. I want to tell you something, okay? Most lenders, refinances are relatively easy. We're going to get to some detail here in a minute, but let me give you the percentage now. In the market today, every loan that's done, 6 out of 10 are actually refinances. That's right. Of all the loans that are being done today, 60% roughly right of them are for the purpose of refinancing. Almost 60%. That's what our competition is doing. They're doing refinances. You know why? They're easier. There's no realtors involved. There's no financial contingencies, no timelines. There's no dates and times you got to close. You can close whenever you get there. So they're easier transactions to do for lenders. That's why lenders, not us, but lenders are doing about 60% of their loans today in the refinance business. Ours are about 80%. 8 out of 10 that we do today are for purchases. We're doing friends and family past customers, sure, but we're not open for business for everyone's refinance. Why? Because that would close us for business for your business. And we're not doing that. Why? Because you're our partners and we want to make sure that we can continue to deliver because you need to get paid and we want you to get paid and we need to get customers to move in this country. So that's what we're doing. By the way, let's talk about how long does it take now because there's so much business in refinancing this year with our competition. How long does it take for them to make wine? I mean, to do a loan. Okay, well, it's taking them 47 days on average to do a loan. 48 for a refi. Oh, they're much better. 46 for a purchase. This is the nation today, okay? Be careful you don't let your borrower go just anywhere. News you can use. Get this to your borrower because there's not a lot of inventory when they put a contract in and they want to go get with a lender. If that lender can't go fast, it's a problem, right? That contract's going to expire, maybe lose their earnest money, all kinds of problems, and you will get paid in 46 days. Would you rather get paid in 47 days? That's the numbers, actually. On the national average with a national lender, with another lender, or would you rather get paid with Supreme in 21.9 days? Okay, it's Supreme, 21.9 days. Then just do the right thing. Start with Supreme. Send us the customers. Tell your customers if you've ever made a really wise choice. This is not the time to go chasing the lowest interest rate in the world and get with a lender who'll never be able to close it because they make wine for a living. Okay. By the way, so we have now established that we're at an all-time record low on interest rates. There's plenty of news articles out there that say it, but it's not exactly a one-size-fit-all event. There's this thing called LLPA. This is not a Supreme thing. This is an industry issue. It's the loan level price adjustments. Basically, the investment community takes the profile of the customer, the risk profile of the transaction and the customer, and then they apply what's called LLPAs. There might be 0 LLPAs, no loan level price adjustments. That's rare. Usually there are some price adjustments based on a number of different things: credit score, loan to value, property type, loan amount, occupancy status. All these things can affect the rate your customer will actually pay versus what the media tells them. And let's give you a bird's eye view of this. If we could, meet the Smiths. Fine family. Fine family. All right. Here we go. $300,000 purchase price. This is a conventional 30-year fixed rate mortgage. They're going to put down 25%. Great down payment. Cool, right? Single family detached, so they're not getting any LLPAs because of those ideas. Credit score 780, very high. Almost the best, right? So they break the barrier of 3%. They get to pay 2.99%. They only have 1/4% as an LLPA. Not bad. Not bad, okay? Now let's meet their next door neighbors who just moved in. Smiths, meet the Joneses, all right? They're buying right next door the Smith. They're going to be fine neighbors and friends. They buy a $300,000 purchase price. They don't put down 25%. They put down only 5%, which gives them an increased LLPA, a penalty, if you will, because the risk profile of the transaction with a lot less down payment is higher. Same as the Smiths, we've got a single family detached. Credit score, 660, not 780. So they get another LLPA. And guess what? Their interest rate is 4 1/8 as opposed to 2.99 because the LLPAs change their risk profile, and pricing then is not what it says it is in the national media. And by the way, they go to a barbecue together, all-time lowest interest rates. And guess what? The Jones find out that they paid 4 1/8, not 2.99, right? And they may be curious as to why is that? They don't know. We're giving you news you can use. We have to tell the customers that this is what's going on. So when they go to that barbecue with their new neighbors, they understand why they paid a little bit more in interest rates. They made a lower down payment, etc. All right, the Jones family goes to our program called Credit Essentials. We're going to replay this story. You bought the same home, so you referred them to us. You started with Supreme, good move. Your borrower still puts down 5%, no change in down payment, but their credit score is 700 now. Magically, we moved them to 700. And guess what? Instead of paying 4 1/8, they only pay 3 1/4. So they did get those historic low interest rates because their LLPA came way down. How'd that happen? Their credit score went from 660 to 700 because we have a program. We'll get to it in a second. All right, so lay this out then. This is just the reality of what goes on. Down payment, 75, 95, 95. Single family, 780, 660, 700. You look at interest rates on the same house with the same, with two different customers' profiles. It could either be 299, which you're hearing the lowest rates in the country, or it could be 4 1/8, or if you send them the Supreme, start with Supreme, we get them into Credit Essentials, we get their credit score to go up from 660 to 700, they can go down to 3 1/4 and really experience some of the best interest rates in history. I'm going to give you one more look here. This is an FHA loan, so those were conventional loans. FHA, same purchase price, $300, max LTV, because most FHA customers put down the minimum amount, fines, single family detached. Credit score of 620, the interest rate's actually 4.5. We get a credit score of 640. We just improve them 20 points. They go from 4.5 down to 3 5/8. That's $150 a month. And when you refer them to us, start with Supreme, you refer your customers, we can put them in our program, and we average getting credit scores to go up about 50 points. So this is what could happen to your customer. If we don't start with Supreme, they could pay 4 1/8. Or if you start with Supreme, they could go down substantially in interest rates, almost 100 basis points, and save $150 a month. Why wouldn't you refer them to start with Supreme? You would. All right, here's the program. It's Credit Essentials for home buyers with Lisa Myers. It's Saturdays at 10, and it's coming Wednesday night starting this week. So we're going to be back in business doing both Wednesday night and Saturday. So your customer is 30 minutes, and they go to this program. You want to see the results? They're pretty impressive. The customers that have been referred, start with Supreme, by you, that we put in the program, they started out with a 611 credit score. They finished with 665. We just showed you how 620 to 640 saved almost a full point in rate. 4.5 to 3 5/8, $150 a month. We're getting more than that in this program to take place. Start with Supreme. Oh, by the way, we don't do a ton of refinancing. We're not distracted. And we don't make wine. We make loans. So if you start with Supreme, you're going to wind up doing what's best for your customer, and you're going to do, therefore, what's best for you, because in the long run, we want both of us raving fans as customers. That's what we both want and need to build the future of our business. By the way, we still have capacity to go really fast. You like our car? It goes really fast. If you put your borrower in our car, we can rev it up and get to a closing in 8 days. That's right, 8 days, where the nation's running and almost 50 days, and we average 21.9. When we need to go a lot faster than that, we can. And we are intentionally managing our business to make sure we can keep the window open to make transactions like that for purchase money buyers like yours available, so that you have a favorable way to set up your contracts with your borrowers. Just start with Supreme. Makes it easy, doesn't it? All right, Supreme Rescue Service. Now, if a customer didn't start with Supreme, they should have, but if they didn't and they get in trouble, which they're probably going to based on the refinance market, there's an awful lot of that's happened already, and it's going to grow because the refinance business is growing. We will play Superman, Supreme Man. We have a program called Supreme Rescue Service. You get in trouble, send your customers to us. Even though you didn't start with Supreme, we'll take them through the Supreme Rescue Service. We'll assess the situation, and then if we can, we will execute to deliver the industry's best experience, which is what we're after doing. Oh, by the way, on that topic, we got all the data that says we are delivering the industry's best experience. Our customer sat rates are 98.7. 98.7. By the way, the 1.3, we're still for them. Of course we are. We do the best we can to be for them, but let's say people are a little bit, unhappy these days. Some people are anyway. Anyway, so 98.7. Close on time, fund on time. Why does that matter? You know why that matters. You got to close on time so your customers can move in on time and you can get paid on time. We do that 99.5% of the time. 99.5, we close on time, fund on time, and get you paid on time. And I've already talked to you about our really fast car. Put your borrower in it. We'll give them for a really good drive. Seatbelts on, boom. I want to finally share with you today our program, Personal and Professional Best. This month we have an amazing, and I mean amazing guest. Profiles and Best, we interviewed Herschel Walker this month who is the legend from the University of Georgia. They won one national championship, the University of Georgia, Georgia Bulldogs, and it was because Herschel Walker showed up in 1980 and basically put that team on his back and carried them ran it all the way for a championship. He not only has been voted as the best college football player in the last 50 years, but then he had an amazing career in professional football. He's also been a U.S. Olympian. He's also been an MMA fighter, and he runs a business, surprise, surprise, called the Renaissance business, right? He's a amazing entrepreneur, and I think you'll find compelling his story because it wasn't always easy for Herschel growing up, but he did what the best do. He accepted the circumstances that were delivered to him, and he became his best anyway. You'll love, and I mean you will love, participating and hearing his story. August 6th at 3 o'clock. All right, we're going to finish where we started, and that is to encourage all of us to adopt, particularly in the times we're in today, but always, a simple way to deal with others, and that is to be for everyone. Even though you don't agree with them on everything, you don't have to be for everything, but you can still be for everyone. That's news you can use for Monday, and we look forward to seeing you again next Monday.